for taking time out of your busy schedules to hop on. Whether you're on for the first time or have been on before, whether you're in a cubicle or you're on here on the Zoom itself. Again, thank you. And then I also want to acknowledge the U.S. men's national team for their win last night, man. Epic. Let's go USA. Just really excited. I'm pumped for that. It is a holiday weekend. This is a some content that I started to dive into last week, which was direct indexing, and just helping you to sort of think about how we view dealing with clients' finances and risks and considerations as we go forward. These calls typically take 15 to 30 minutes. This one will probably be a little bit long. I'll be right up against 30 minutes, but I do speak quickly, and I may be going through some of this content a little quickly, and it's only because I know how many slides we have, and I apologize in advance. So without further ado, our approach, it's dealing with the six fundamental considerations and, longevity, liquidity, inflation, market, mortality, taxes. I am now in my 35th year as a financial advisor. And I can tell you that I have seen, dealt with, and helped families navigate each of these risks. And quite often, what frustrates me about this industry is that quite often a lot of advisors will completely dismiss or not even address areas. It's not even like say, hey, I'm not proficient at long-term care or things like life insurance. So what they'll do is they'll say, yeah, you're okay, or here's some term insurance. And you really should have an expert opinion and even a second opinion to help us to figure out, so our philosophy is we're going to start smart, right? We're gonna, what works for you and your family and the risks that you're comfortable with. We need to dial in on that up front and make sure that we're looking at it through your lenses and what's important to you. And then we're going to apply discipline. And, we're basically using technology, experience, and expertise to help us to drive towards these goals. And then this is the key, communicating, right? This is what it's all about is saying, hey, listen, if something's going on, whether it's in your life or in the markets or maybe you just got questions, we need to be in a environment where you should be able to get the answers that you want in a timely fashion. So, just at a real quick high level, again, financial planning considerations, longevity, right? It's not just a risk, it's a risk multiplier. So, as we transition to retirement, and let's say that I'm the client I'm going to see tonight, longtime client of mine, and he's 64, he's going to be 65. Let's say he retires next year. I have no idea how long he and his wife will be on the planet, but I plan for roughly, we speak to 30 years. Well, that's like being on unemployment for 30 years. So we have to make sure that we've saved enough. And then these other risks, not only are they likely to happen over the next 30 years, but they are likely to happen multiple times. And that's why I view longevity risk as a risk multiplier. So liquidity, this is one I typically I don't I think most people are so caught up in the old way of doing things. Oh, put money in a CD, put it in a savings account. Let's just put it someplace where I can get to it, and we should be able to access and make sure that hey, if the boiler breaks, the HVAC breaks, the driveway needs to be repaired. We need to be able to get our hands on cash. But on the same token, quite often I see clients have way too much money sitting in idle accounts. And, so we're not taking into consideration this next one, which is inflation, right? So, we know that it's here. We understand that it's going to continue to be here. It goes up, it goes down, but we have to stress test our plan to make sure that we're not overly optimistic and oh yeah, I did an online sort of do it yourself type analysis of my finances and I'm good. And I've seen them before, and quite often folks that have taken that approach are shockingly surprised when they look at and see what we've done from a stress test to say, hey, you might not be as comfortable as you thought you were. So we have to plan for worst case scenarios. Market and volatility and, an exposure to assets, but in a thoughtful, meaningful manner. Mortality, again, this is an area where nobody likes to talk about this. But again, having lost my dad at 50, it is an area that I am absolutely I feel it's my moral duty to talk to everybody, even though it may not be the topic you want to talk about. And then taxes. It's the taxes, it's the taxes, it's the taxes. And that brings us to tax loss harvesting today. I will get there, I promise. All right, so starting smart. So basically, this is in the world of just planning what an investor can do. And so, quite often we have a process. We're collecting data, we're collecting documents, we're understanding, we're having conversations. But before that, if an investor was either trying to do this themselves, maybe they just were listening to water cooler advice, a next door neighbor, maybe a family friend or even a family member, or the maybe it's at work, the guy that comes in once a year to talk to you about the 401ks, whatever the outcome is or the suggestions. Quite often what we've seen and what I've learned over my career is that quite often it's moderate at best, right? That's being very, very gracious, right? That quite often folks, listen, we all want you to make money, but quite often the amount of risk that we're doing. So what we couple that with is what an investor should do if they had all the information or at least more information. And that's what we at Simplicity Wealth of Princeton do is we help you to couple that, right? To make sure that your unique puzzle is put together. One of the tools that we use is proprietary. It's called a bar score. And really, I've gone over it last week a little bit and real quickly. It's the amount of risk that we're comfortable with, the magnitude and the speed. And I think this next slide shows that. So if we had $100,000, right, and we know that, hey, listen, our investment within a lost 20%. Well, if that happened over a 12-month period, you would not be happy, but you not might not panic. However, if that same scenario happened within 3 months, it could completely trigger tilt you or maybe just cause you to sell and get out at the wrong time. So understanding your tolerance and risk and scoring your household is a critical component of what we do. So the key question is what percentage of loss over the course of a year would make you aware, worried, or alarmed? So, if I take aware, I take worried, and I take alarm. And in this portfolio, it's not stated here, it is on the next slide, is let's just say it was $1.5 million. And as we were getting to know them, they said, hey, listen, if the markets were to go down 8%, I would not panic. I got $1.5 million. But in real numerical terms, 8% is $120,000. It's a lot of money. But if within that 1 year period it went down 10%, well, that's 150 grand. And now you're turning around and maybe you're talking to your significant other, your spouse, or you're having real concerns. But where it really gets, I think, the rubber meets the road is if your tolerance is 15% within 1 year and it went down and we hit red, right? This is Houston, we have a problem. Now out of your, million and a half, right? At the end of 1 year, it's 1,250,000 or 275, right? We have to be aware that this if we go into it with our eyes open and we have a plan, that's one thing. If you can handle this amount of risk, great. But if not, what I find is when we're doing these proposals and we're collecting documents, what people initially had is not necessarily what they wanted. So once we score, and you'll see we have a scoring thing at the bottom, and I view this as a sort of almost like a speedometer. So as people are approaching retirement, I view this as like I'm comfortable doing 35 miles an hour in a residential area, right? That's how we should be. But maybe if you're younger, you have an appetite for more risk, maybe we could slide over to the right into moderate or moderate aggressive. Well, as we do this, right now we turn around and if we know our score is 35 and we've assessed it, and this family had 1.5 million, and in a 3 month period, it lost 5%. The family's not panicking because we've measured this correctly. But now over a 6 month period, now what happens is it just expands the amount of risk or gain that could happen. And it just makes sense, right? That the longer time passes, the more that we may see drifts in either direction. But even over a 1 year period, if for this client, let's say they had that alarm of 15% and they saw it at 9, they would not panic because we've already had these conversations and measured and built a strategy and portfolio that was unique and specific to them and their tolerances. So really proud of this. It's where I think the industry should be, and it's one of the reasons why we came over to Simplicity Wealth of Princeton. Right. So now when we apply discipline, right, first we're gonna, the team, the investment team we have, and the financial planning team, right? And then we're gonna monitor the portfolio. So designing a portfolio, well, what you have to understand is that there's probably in excess of 34,000 money managers. And our financial planning team has really vetted those down and narrowed that funnel down to about 150 plus, right? And within those money managers, there's thousands of strategies. But we do, and we're regularly revisiting these strategies. And then we ultimately take that down to a funnel so we can get down to about 15 to 25 money managers that we feel we're comfortable having our clients exposed to the strategies that those specific money managers offer. And then we're constantly measuring that strategy against the bar that we did initially. So it really is cool. But as you look at this, depending on where somebody's risk score is, maybe Columbia Threadneedle will come in at a 38. But somebody like Global might be middle of the road at 50, and you go, okay, I really like that strategy. So we have to just make sure that we're matching our clients' risk with investment strategies, or maybe Inspire, right? They're a little bit more aggressive, and maybe they're comfortable with that, and maybe it's a blend. These are just examples to show you how a VAR score helps us to dial in to strategies that we've already vetted and I think are risk appropriate for our clientele. So apply disciplined investment strategies. Obviously, we have active management, passive management, income strategies, whether that be some type of private pension, like a personal annuity, that's separate and apart from an investment strategy, which might be a dividend strategy, or sustainable. Maybe you're very in tune with, sin stocks, and you say, I don't want any tobacco or alcohol or anything. Specifically that goes against your moral fiber, you can start to dial in strategies that mirror sort of your philosophies. Now, we talked about direct indexing last time, and that was like taking an index like the S&P, and if you have enough money, we can start to go in and roughly if it's 500 stocks, right? We might, depending on your capital gains budget, might maybe we can do 200 or 300 and create a stock basket that allows you to individually own, and it gives you the ability to track an index without having all 500 stocks. What we're going to talk about today, though, is tax loss harvesting and selling some of those stocks as a loss to offset the gains realized by selling other stocks at a profit. And then a tax optimized transition is a sophisticated strategy. I'm not going to get into that today, but it's just letting you know that Simplicity Wealth and our team is really cutting edge, and I'm really proud that the direction where we're going and where I think that all our clients deserve, because it just allows a series and a level of professionalism that, quite honestly, I wasn't able to provide before. So this is direct indexing and tax loss harvesting. It's a little hard to read, so what I did is I blew it up. Using an investment loss to lower your capital gains. And if you look at investment A, and I'm just going to, I'll show this on the next slide, but roughly, let's say that you bought Apple, right? So you bought Apple and you bought it for $50,000 and it went to 70, right? Bravo. You made money. You got $20,000 of gains, right? And then we turn around and say, hey, but on that 25, depending on what or the tax bracket is for the client, could subject them to $7,000 of stock. But investment B, maybe it's Nike. So you turn around and you put in 50 grand to buy that stock. And now you turn around and sold it and it's now at 25,000. So that loss, and that's what tax loss harvesting is allowing us to reap the rewards of the winners and simultaneously offsetting the losers. So let's go through this a little bit slower, but with a little bit of individuality. So this is a hypothetical client. They bought Apple, just like I said, 50, and then at long-term capital gains rates for 70,000 equals a $20,000 profit. Now, the potential tax owed here, seven. I didn't make this slide. Obviously, and you'll see in my example, if the salary is 100 grand for somebody, that's taxed at ordinary income, and then subject to all your other holdings, that's marginal tax bracket. This presentation was not intended to be a lesson on taxes. I just, real highly on a high level, understand our tax system. So, the gain was 20,000. So ordinary income was 35 on their taxes, right? So that would be roughly they owed 35 plus they had long-term capital gains, 15% on the $20,000 is 3 grand for a total tax of 38,000. So again, this is where people look at this and go, ow, that's painful. So this is where we're saying perhaps the client, in dealing and strategizing, they bought Nike or Disney for 50 and sold it at long-term capital losses, right? So what's cool about the IRS code is that we're allowed to, for dollar, to eliminate any gains with any losses that we experience within a portfolio. So as I look at this, first set, we had the $20,000 gain, but our $25,000 loss completely offset it. So therefore, we dodged a bullet there we missed out on the $3,000 of taxes they might have paid otherwise for capital gains of zero, capital gains tax of zero, federal tax saved, they saved 3,000. Now, remember, we still have a $5,000 loss. And now what the government says is, hey, listen, you can't take all that loss. So you still have $3,000 of that loss, right? So on that $3,000 loss, basically at a 35% tax bracket, that roughly, right, your 1050 would have been the taxes owed. So it just allows us to basically be efficient, to allow us to pick winners within the portfolio, maybe sell it. So let's say that Disney and Universal Studios were side by side. They're very close, right? In sort of goals and sectors. So we'll turn around and maybe though, because we got bad press on Disney, we might sell it, but simultaneously step in and buy Universal Studios to sort of segue. And that's happening internal by the investment team. But now ultimately, this is just the summation. So the capital gains tax without tax loss harvesting ended up in this example would have been about 38,000. But after capital gains tax is zero, ordinary income, that's still going to be there, 33,950. But total taxes saved was about $4,000. And this is a way to shrink. I always use the analogies of a bucket, right? Because my background's mechanical engineering. So I go, if we have a leak in our bucket, what we're trying to do is reduce that leak, slow the leak, and even if we can, completely stop it. But this last little note, the $2,000 we were not able to utilize, we can carry forward to future years. So this is the strategy that for accounts. And when I use the term non-qualified, what I mean is for something that's not in an IRA or 401k. This is for money that we have in a brokerage account, or where you're getting crushed with a 1099 every year, INT, and you're paying way too much in taxes. This might be a strategy for you to look at. So, applying discipline in the planning process, first, we're going to obtain a risk score. We're going to talk about the financial planning considerations. We take a holistic approach. We're going to figure out your income sources and expenses. Then we're going to look at those risks, the limit, right? So we got the longevity, we got the liquidity, we got the inflation, we got the market, we got the mortality, we got the taxes. And then what kind of timeline are you on till you might need funds or want funds? And make sure, are we at risk of running out of money? And then we have our financial planning and all the technologies that we have at Simplicity Wealth. We do a portfolio analysis. We're basically going to take a look at what you currently have, help you understand the risks that you're currently at. What speed are you going down the highway? And then we're going to ask you the question, now that we understand what you said you were comfortable with, does that match up to where you're trying to strive towards? So tax management, if this is an area, right, we're going to look at qualified plans, tax sensitivity. Maybe we're thinking about Roth IRA conversions, asset location, tax loss harvesting, tax transition, muni bonds. Portfolio focus, again, tax concerns, income growth risk, total return, time horizon, and then maybe, and this is a way we can actually introduce income to the portfolio, or at a bare minimum, we have a no loss component so that we make sure we don't go backwards. And then management style, right? What are you comfortable with? Maybe federal employees tend to be very set it and forget it. But when I share with them, hey, listen, are you aware that, just sitting in the G fund is causing you to go broke? And like quite often they're surprised, but and because it's so easy to jump in and out from the S or the C and go to the G, they'll turn around and go, wow, they're almost timing the market, and they do so at their own detriment. And then lastly, specialty. So if there are things that sort of fit from a strategic standpoint, your overall planning and strategies, we're going to bring and suggest those. And the ESGs, which are socially, environmental, social, governmental type strategies, buffered. We do like buffered. So there's ways to invest sometimes in ETFs where we can put downward protection, right? So everything has a cost. We just have to understand what that means. Direct indexing, I think Simplicity Wealth is really, really leading the industry in this area here. So it's funny when I'm talking to clients. I have a client right now that's a CFA at a large financial institution, and he was like, "This is the one area that caught his attention." And then individual bonds, separately managed accounts. And then ultimately, we're going to create an investment proposal for you. Now, those proposals have a lot of data. What I try and do is take you through and help you to understand what that looks like for you and your specific circumstances. And then we're going to communicate that process, right? So, we act on each other's behalf. We're accessible, we're consistent, and we're transparent. So, we're going to, and they go, well, whoop-de-doo, everybody does that. But, getting quarterly reports based on this and saying it just allows you to be able to sleep comfortably at night. You've worked hard for 20, 25, 30 years. This is your money. We don't want to turn around and have another COVID-19 happen and turn around and you just, I don't want to look at my accounts because I'm afraid it's my 401k has been cut in half. It's not necessary to have that overexposure to risk. And what we absolutely encourage is having a plan and a strategy. then timely updates is needed. This is not a set it and forget it, but monitoring, making sure that either a global environments or whatever's going on or portfolio drift. If we started off and saying, hey, well, this is where we wanted to be, but one sector was up and now we're a little bit out of balance, making sure that we're following a thought process. And then 24/7 accessible online. We have client portals, we have information. And then again, all my clients get my cell phone number, right? I'm around, I'm running, but I will get back to you, right? So this is why I love what I do, and I love helping people. And then lastly, this proprietary software, I'm going to ask everybody on this call. I am not going to stop saying it because everybody needs to know who is watching all of your accounts 24/7, 365 days a year. And the reason I pause there is because I want you to think about that question. I know, and I'll keep the focus on myself. As much as I would love to, it is impossible for me to watch every account, every hour of the day, 7 days a week, 365 days a year. I couldn't do it. I can't do it. But implementing technology that is proprietary to Simplicity Wealth, we feel this is what you deserve. There is no cost to this to be on part of our platform. So we really strongly encourage, and this is going to be my topic next week, and I'm going to get into a deeper dive. And then lastly, folks, we live in the greatest country in the world. Happy birthday, America. It's our 250th birthday. I got family and friends coming over this weekend. I've been busting my butt getting things ready. My back hurts. I still got stuff to do. I got to go and see a client now. And then I got to start smoking pork butt and got to inject it and get it ready for this weekend. Folks, everybody, I want to wish you a wonderful 4th of July. And here's our disclosures at the end. As always, if you need me, you want to reach out, you have any questions, please do so, and look forward to seeing you in the future. Have a great day. Happy 4th of July. See you all next week. Be safe.